Hello guys, welcome to TechGrowthStocks channel. Today I'm going to make an educational video about how to analyze high growth stocks. I will give you fundamental characteristics of leading tech growth stocks. Specifically, I will give you 6 top criteria for high growth stocks. And I will analyze 5 stocks. So you will have 5 examples of how to see these criteria in action. So let's start off with the first stock, and you can see it on the screen. It is Shopify SHOP. So, okay, let's start with the first criteria. The first criteria is the stock should have strong earnings surprises. So let's have a look at Shopify. How is it with the earnings surprise? You can see here the last earnings was for the 30th of or 29th of July with the earnings date, and for the period ended 30th of June, which you can see here. And at the top we have the diluted EPS, and the second number is the EPS estimates. So you can see it reported on the 30th of June, or for the period ended 30th of June. The report was the diluted EPS was 29 cents, and the EPS estimate was 1. So the EPS as surprise would be very high, because you would divide the diluted EPS by the EPS estimate. So it would be a very high percentage. It would be like, let's say, 2,800 times or something EPS surprise. So very high surprise for Shopify. So this would be a positive indication, a good characteristics. So in general, we look for strong earnings surprises in our high growth stocks and in our leading tech growth stocks. So let's have a look at the other criteria. The next criteria would be strong quarterly EPS and sales growth. Especially what I like to look for is average quarterly growth for EPS and sales. Yeah. So let's have a look. Okay, we can see here Shopify, the earnings growth isn't that good, it's negative. I mean, this for many high growth stocks, the earnings can be negative, and the EPS growth could be negative. So this can be the case. But more importantly, to select very good growth stocks, it's always to have strong revenue growth, and especially over the whole period only have positive revenue growth. Because in the end, it's like where the action is. The stock has strong revenue growth, and later the earnings will come in the future, because the highest growth stocks, they trade on the future, yeah, on the future earnings, and these will materialize if the stock continues to have high revenue growth. At one point, the earnings will come, and it will also have earnings growth and strong earnings as well. So here you can see, when you look for the revenue growth, the quarterly revenue growth for Shopify, you can see, yeah, I mean, I go to the minimum growth, and this has been 44%. I mean, over many quarters, yeah. So this is quite positive. It has a history of strong positive revenue growth. This is good. And in general, for earnings and sales growth, I like to see earnings in excess of 20%, which I think it's quite good. Quarterly earnings growth in excess of 20%, and sales growth in excess of 15% is quite good, I think. Yeah, so this was number 2. The criteria number 2, the strong quarterly earnings and sales growth. The next criteria is what we look for. This would be EPS breakouts, so that you can see EPS breakouts. This means the earnings would be in one range for some time, and then there would come a new earnings quarterly or annual earnings, and this would break out of that range. Let's say the earnings were around $1 and some for, let's say, over the last 1 year or 2 years or 3 years, and then suddenly a new earnings release come and the earnings would be $2. So the breakout would be like 100%, or the change over that period of relatively same earnings would be 100%. Yeah. So this would be quite strong. This would mean a very strong breakout. So let's have a look at Shopify if we can see a breakout. Here you can see the diluted quarterly EPS. And when you look, let's say the quarterly EPS was around, now you can say, it was negative, yeah. It was, let's say, around minus 10 cents, yeah. And now you can see the last earnings here was 29 cents. So if you say it was around minus 10 cents, you would take the absolute amount. This would, let's say, 10 cents, and now it's 29 cents. So it would be a breakout of 200%, which is quite strong. It's a very strong breakout. So this would, so Shopify would meet the EPS breakout criteria. I mean, not every stock has an EPS breakout to be a good growth stock, but when you see one that has a strong breakout and has the other previous criteria, so this would be a good candidate. Yeah. Okay, guys. So the next thing is strong margins and expanding margins. This is also a strong criteria for a high growth stock. So let's have a look with Shopify. What we can see there. Here we have the net margin, and in the chart we can see. So the previous quarter, the stock had a margin of, say, of minus 6%, minus 7%, yeah, because it had negative earnings. Yeah? And now for this quarter, it has a margin of 5%. So the margin expanded, which is a positive sign, which is good, yeah. So, and yeah, last but not least, the last criteria, or no, the second last criteria would be strong annual EPS growth. At the bottom, you can see the EPS growth of Shopify, which is not that good. I mean, in the year for the change of the year for 2019, we had the growth of minus 80%. This is clearly not good. But we can see, if we compare in the chart, the last growth was really good, yeah, 29%, 29 cents a quarterly growth, yeah. And here you can see, I mean, in that history, it's the highest EPS, and before it was always negative. So this is kind of a game changer for Shopify. The first time the earnings went into the positive, yeah. At least for the time we can see on the chart. So this is quite positive. But in general, we would like to see strong annual EPS growth, and I like to see in excess of 20%, which I consider quite a good growth. So, and now we come to the last criteria, and I look for this as well for a leading tech growth stock, and this is having a high valuation. So I'm not looking for low valuations, because this is about tech growth stocks, and the most tech growth stocks have very high valuations, and the higher the better. I would say the higher the better, yeah. And this stock has an excellent valuation. For instance, if you look at the price to book ratio, it has a price to book ratio of 27.75, so 28, around 28 price book value. So this is an excellent, has an excellent valuation. So in general, I would consider a good candidate to have a price book ratio in excess of 8. So this would be the last criteria. And this matches for Shopify. So Shopify has strong earnings surprises, has strong sales growth, like we talked about. The EPS growth is not that good, but it has a strong EPS breakout in the last quarter, and also it has expanding margins and a way high valuation. So in that list of these 6 criteria, it's meeting, let's say, four to five criteria, which is quite strong. Okay, guys, so that's it for Shopify. Now I have to speed up a little bit because otherwise the video gets too long. The next stock I wanted to talk about is that app, Zoom Video Communications. Yeah, here you can see the characteristics. Let's start with the first criteria. The first criteria was having strong earnings surprises. So here you can see the last earnings surprise. When you look here, the quarterly diluted EPS was 62 cents and the EPS estimate was 45 cents. So you can see it had a strong surprise, let's say around 40%, which is quite good. Yeah. So it had a strong earnings surprise, top. Yeah. The next criteria was strong quarterly EPS and sales growth. So let's have a look. Here we can see the EPS diluted 1 year growth quarterly. And you can see, yeah, it had a very strong quarterly growth of nearly 3,000% in the previous quarter, and a strong revenue 1 year growth in the previous quarter of 355%. So it's meeting both of the criteria excellently, and yeah, so really strong has really strong quarterly EPS and sales growth. Zoom Video Communications. Okay, the next criteria was having an EPS breakout. So let's check this. So we check the quarterly EPS, and here you can see the previous diluted EPS was around 62 cents, and before it was around for a long time, yeah, about 10 cents. So it broke out of that 10 cents to 62 cents, which is like a 500% EPS breakout. Excellent EPS breakout. And one note, here I show you the quarterly the EPS numbers, but in general for the EPS breakout you would look for annual number. You would take annual EPS numbers, so you would look for let's say a breakout over the last 3 to 5 years. How let's say over the last 3 to 5 years the EPS was in a range, and then in the most current year you would look for a breakout of, let's say, 50% or more, and this would be a strong breakout, a strong annual EPS breakout. Okay, guys, so it had a strong quarterly EPS breakout. The next thing we look for are the margins. So let's have a look at the margins. And here you can see the previous quarter, or let's say the previous quarter we had like a 28% margin, and before we had 8% margin. So we had a strong expanding margin for Zoom Video Communications. So a top, so we can say, yeah, has top characteristic with the margin as well, the Zoom Video Communications. Okay, the next criteria was a strong annual EPS growth. So let's have a look at that. How is the EPS growth? And here we can see the annual EPS growth is 42% or nearly 43%. Has excellent EPS growth. I said in excess of 20% is very good. So it's meeting that criteria as well. So, and now we come to the last criteria. The last criteria was having a high valuation, because strong tech growth stocks or leading tech growth stocks have high valuations. Here you can see price book ratio of 136. strong price book ratio, the higher the better. So this stock has excellent valuation for our matters. And so yeah, cannot say any more. Zoom Video Communication is meeting all the 6 criteria strongly. So it's definitely a top pick for a leading tech growth stock. Okay guys, that's it for Zoom Video Communication. Now we go through the criteria for the next stock. The next stock is AMZN, Amazon. Okay, let's have a look at the first criteria, having strong earnings surprises. Yeah, so let's have a look. So for the last earnings, the diluted EPS was 10, around 10, and the EPS is the quarterly estimate was around 1.5. So we can clearly see when we divide the diluted EPS by the EPS estimate that we had in -1. This would give us a change, or let's say the earnings surprise change of the actual EPS to the estimated EPS. And yeah, this would be clearly positive, strongly positive. So we would have a strongly EP earnings surprise, and yeah, a very good number. And so Amazon is meeting the strong earnings surprises. So the next criteria would be having strong quarterly EPS and sales growth numbers. So let's have a look at the EPS and revenue growth, or sales growth. The first is for the last quarter we had a EPS growth of 97% and a revenue growth of 40%. So these are very strong numbers. As I said, I would look for at least most of the time I would look for at least 20% EPS growth and 15% sales growth. So it's meeting both of these numbers. So Amazon has very strong quarterly EPS and sales growth. And as I said at the before, in general, I would look for quarterly average numbers. So for instance, I would take 2 quarters and average them out for the EPS growth and 2 quarters for the sales growth and average them out in order to avoid a little bit the quarter to quarter volatility or change in the growth rates to smoothen that out a little bit. So you can do that, and it works quite well. Yeah, so it's meeting the strong quarterly EPS and sales growth. The next criteria was having a strong EPS breakout. So let's have a look for the previous quarters, for the last 5 quarters, how it does it look like. So the first here, the 4 quarters were around, when I look here, let's say around 6, yeah. And now we have, for the last we had 10 as earnings, yeah. So we can say we had a strong breakout, a strong EPS breakout of, let's say, 70-80%, which is quite strong. So it's meeting the strong EPS breakout. Amazon is meeting the strong EPS breakout. Okay, the next criteria, what was it? Yeah, the next criteria was having expanding margins. So let's have a look at the margins. The margins are here below. We can see the margin was here, it was 3.36%, and now it is 5.9%. So we have strong increasing margins. Yeah, so we had an expanding margin, which is quite good. So it's meeting that as well. That criteria as well. Amazon is meeting that criteria as well. So and now the last, the second last criteria, having strong annual EPS growth. So let's have a look. Where's this annual EPS growth? It's at the bottom. We have an EPS growth of 14%. We can see, it dropped. The year before it had very strong EPS growth of 227%. And then in 2019, this was in 2018, and in 2019 it had an EPS growth of 14%, so it dropped strongly. But like with the current numbers, we would expect to see for this year, for 2020, a much stronger EPS growth. So, and it's around 40. Currently, it's around 14%, which is not too bad. So I think we can say, okay, it's meeting that criteria. Not too bad. I mean, it's not the top. Doesn't have the top number. In general, I would say above 20 is good, but for Amazon, these 14% of last year, for the last year, is not too bad, and this year I think will be much better. Okay, guys, so that was it for Amazon. Let's look, now I show you another stock as well. We go through the criteria quickly. The next stock is NFLX, Netflix. Okay, the first criteria was having strong earnings surprises. Generally, in excess of 50% or more is good, but let's say 20 can be also 10 or 20% is also not too bad if you have a series of strong earnings surprises. Okay, so the last earnings were here we can see, the diluted EPS. The last EPS was 1.58 and the EPS estimates was 1.82. So Netflix is not meeting that criteria. Can say that, Okay, the next criteria was having strong quarterly EPS and sales growth. So let's have a look at that. EPS, the last EPS, quarterly diluted EPS growth was, 1 year growth was 164%. And the revenue growth was 24%. So, so it's meeting, Netflix is meeting those criteria. The EPS growth is strongly in excess of 20%, and the sales growth is also quite in excess of 15%. So Netflix has a very strong quarterly EPS and sales growth. Now, the next criteria was having an EPS breakout. Okay, we can see from quarter to quarter, and now it has been for some time at that level where we are at the moment around $1.5, $1.50 for the quarterly earnings. But before we can see there was a period of about 0.57. So we had an EPS breakout for the earnings as with the earnings date ending 30 September 2019. There we had a breakout out, but currently we do not have a breakout, but before there we had that breakout. And here you can see quite nicely we had that breakout, and this coincides also with a low, and after this we had a nice uptrend, because we broke out to a new and higher earnings level, and I think it had a favorable effect on the stock price, or one could say, I mean, not only this, but I think it's a strong factor, because when the earnings break out to a new level, I mean, this has strong effects. You can see it in the growth rates and so on, So, not too bad. The EPS breakout as of September 2019. Okay, guys, the next criteria was expanding margins. So let's have a look. How are the margins of Netflix? Okay, so from quarter to quarter, we do not have expanding margins. They have a decreasing margins, but a slightly decrease. So overall, we can say here for some time, the margins have been on one level. But here we had an expanding margin, a breakout. This was a quarter which coincides with the EPS breakout for the 30 September 2019. But I would say at the moment no expanding margins, but also not really decreasing margins, flat margins. Okay, the next criteria was having strong annual EPS growth. So let's have a look at the current or the last annual EPS growth, 54%. I have to look strongly. Yeah, this very strong annual EPS growth. So we can check mark that it's strongly in excess of 20%. Yeah, guys. So that's quite good. And yeah, the last criteria, having a high valuation. So let's have a look. Okay, we can see the price book ratio is currently around 25. So it has a high valuation, a very high one, and this valuation is in excess of price book ratio of 8, what I like to see. And so it has a good valuation for our purposes to select leading tech growth stocks. Okay, guys, that's it for Netflix. Let's have a look at the next stock, at the next stock example. Okay, I wanted to look at this stock. ETSY, Etsy. Okay, let's look at the characteristics. So the first leading criteria was having strong earnings surprises. So let's look at the earnings surprise of the last quarter. So Etsy had a diluted EPS of 74 cents and the EPS estimate was 39 cents. So it had a strong earnings surprise. The actual EPS was much higher than the EPS estimate. And if we calculated, it was like 25 cents higher. So around, let's say the earnings surprise was around, 60% or something around this number, yeah. So which is quite good. So Etsy had a strong EPS surprise. Yeah, and as well. So the next criteria was having strong quarterly EPS and sales growth numbers. Okay, let's have a look at them. The diluted EPS 1 year growth was 436%. And the revenue 1 year growth or sales growth was 136%. So these are excellent numbers. So the EPS growth was in excess of 20%, and the sales growth was in excess of 15%, like what I want to see. So Etsy is meeting these criteria strongly. Okay, the next criteria was having an EPS breakout. So let's have a look. The diluted EPS was 74 cents, and previously, for a long time, the EPS were around, let's say 20 cents, yeah, or less, even less. And now 74. So it had a strong breakout, nearly 200 to 300% EPS breakout. Strong breakout, strongly favorable for that stock. Okay, guys, the next criteria was having expanding margins. So let's have a look at the margins. We saw the margin last quarter. It was 22% margin, 22.5% margin, and before year was 5.5% margin. So it strongly increased from 5.5 to 22.5%. So it has expanding margin, which is quite favorable for that stock. So, and now we come to the last criteria. Last criteria was having a high valuation. And when we look at it, Etsy has a very high valuation of 33, a price book ratio of 33, which is excellent. It is in excess of 8, and this is exactly what we want to see. So it's meeting that criteria as well. So guys, these are the criteria. I go through them quickly again. The first criteria is having strong earnings surprises. The second criteria is having a strong quarterly EPS and sales growth. In generally, I like to see an EPS growth in excess of 20% and the sales growth in excess of 15%. The third criteria is having a strong EPS breakout, preferably a yearly breakout compared to the last 3 to 5 years. And the fourth criteria is having expanding margins. The fifth criteria is having strong annual EPS growth in excess of 20%. And the last criteria is having a high valuation. Generally, I look for price-book ratios in excess of 8. So these are my top 6 criteria for finding leading tech growth stocks, guys. Check these criteria out. Have a look at the stocks. Look if these stocks are performing. Build your opinion. So I think I use these criteria often, and I found that these are the best criteria for me. And so I wanted to share them with you. Yeah. So guys, and please don't forget to subscribe to my channel below, and also leave me comments if you want. I will make more videos like this, and I would be happy to have you on board for the next videos. And I have many plans to make similar videos, and I think these videos can benefit could benefit your to you, could be benefiting to you. So guys, don't forget to subscribe, and thank you guys for watching so long and staying so long with me and in this video. And yeah, I wish you good trading, guys, and yeah, check these 6 criteria out. I think you will definitely do better in your growth stock selections. Okay guys, see you next time. Stay tuned and take care in this corona pandemic. See you soon.